what is private mortgage insurance or PMI? So mortgage insurance, there's two types. There's a mortgage insurance you get when you purchase a home using a government type loan like FHA. And that mortgage insurance is for the life of the loan on that product, okay, on the FHA product. Now, if you put more money down on that product, it can lower and the term can lower. So for example, I think if you put 10% down on an FHA loan, the mortgage insurance will go away after 10 years, or you refinance the mortgage. So keep that in mind when you're getting an FHA loan. Doesn't have to be forever. Once you refinance, you can, if you refinance out of FHA, and let's say you have the equity, you no longer have to worry about mortgage insurance. And if you are curious, you want to reach out to your mortgage professional to keep track of that for you. Now, the other cool thing with the FHA loan is if they ever change their mortgage insurance rules, you can do an FHA streamline refinance to then take advantage of their new mortgage insurance rules. Okay. With FHA, not only are you paying the mortgage insurance monthly, but you also have to pay an upfront fee. Now, this upfront fee can be financed into the loan. 90% of the time, it's financed into the loan. So when you're doing your research and on FHA and it says a lot of your closing costs can be financed into the loan, that's what they're talking about. They're talking about that upfront mortgage insurance being financed into the loan amount. You don't have to do that because it can increase your loan amount. I've been able to save families hundreds of dollars a month because they have the ability to pay the upfront mortgage insurance at closing, which allows their loan amount to be basically a very simple sale price minus their down payment. Okay. Because the upfront mortgage insurance can add some money into the monthly mortgage payment because you're mortgaging a higher loan amount. So that's FHA government loans. Conventional loans, private mortgage, now you're dealing with the private mortgage insurance. You have a little bit more flexibility on it. So private mortgage insurance protects any mortgage insurance, protects the lender in case you default. So an FHA, it's a government mandated insurance in case you default. It protects the lender and gives them their money, some of their money back in case they lose it in a foreclosure. On a conventional loan that is not backed by the government, they don't really have a lot of options. So there is the private mortgage insurance. Now, the cool thing about the private mortgage insurance is that your lender, as long as they're awesome, should be shopping around for you. And they're going to shop around to find the best rate possible for your mortgage insurance to make sure it's as low as possible. So there's a little bit of competition out there, which is good. The other thing is the more you put down, the less expensive the private mortgage insurance becomes. Here's the secret that no one ever really tells you. There's several different ways you can pay for mortgage insurance. So you can pay for it as a monthly addition to your payment. Okay. So you get a percentage multiplied by the loan amount divided by 12. That's typically how it works. Some people, like I said before, like with the FHA, they have the money to put down. They have money to spend for closing costs. You can do that as an upfront mortgage insurance. It's called a single premium. As you pay the single premium, sometimes that's cheaper than paying a monthly premium every single month for as long as you have the loan. So again, when you have a loan officer, you want to talk to them about your options when it comes to private mortgage insurance. Don't tell them what you need because you don't know what you qualify for yet. But when you do figure it out, tell them you're open to the idea of doing a single premium. Now, the tricky part is there's also something called a split premium. That's where some of it is paid up front and some of it is financed as part of your loan. Or some of it's paid out part of your monthly payment. And that split premium can also save you big on the mortgage insurance. Now, great loan officers, we also know that there's a lender paid option. This can result in a higher interest rate though. So just beware that yes, sometimes we can do a lender paid mortgage insurance. It acts the same way as a single premium where there's a lump sum paid at closing, but the lender is going to cover that through a credit through the interest rate. So you're going to have a higher interest rate, but again, you don't have that monthly mortgage interest or mortgage PMI payment. And since you don't have the P&I payment, sometimes it ends up being cheaper for you in the long run. My point, there's a ton of options to save you money when it comes to private mortgage insurance on a conventional loan. You need to work with an expert who understands all of your options so that we can work out what's going to fit your needs the best. If you have more questions about private mortgage insurance or any mortgage insurance, shoot me a comment or any mortgage question you have. Put a comment in there. Don't forget to subscribe to my channel.